Hey everyone, Andrew Moss here, chartered market technician and professional trader with T3 Trading Group. Thanks for tuning into the video where we're going to cover some basic charting tools and practices. If you are brand new to charts, this video should help you make sense of the basic elements of price action and some simple indicators. And if you've been charting for a long time, I think you'll pick up some tips and tricks on how to use these charts and indicators together to help you better formulate your trading plans. At the very least, you'll have a better context and understanding of how I draw and use charts as part of my process. So let's take a look. Before we get started, I do need to show a disclosure page. Leave this up here for just a moment. And here are my current positions. And now we can get started. So I'm a chart guy. I look at a lot of charts through the course of the day. I post a lot of them to X. I share them in the articles I write. And you've probably seen them before. And chances are, if you're taking the time to look at this video, you probably have a basic understanding at least of what's going on here. But it doesn't hurt to be sure. And even if you do, a periodic review is a good thing. And like I said, at the very least, you'll have some more context and understanding on how I use these charts as part of my process. So let's dig in and take a look at how I build charts, what indicators I use, and how I read them. And we're going to look at things like candles, volume, RSI, moving averages, Bollinger Bands, anchored volume weighted average price, and pivot levels, trend lines, support and resistance. So that sounds like a lot, but what we really want to do is keep it simple. All of these indicators on the chart can work in concert, but we do want to be mindful of having too much. Tons of fancy lines and indicators may look smart, but that's no guarantee that any more useful information is going to jump out to you. Having too many things on a chart can often lead to contradiction and confusion, so keeping it simple will be your best bet. So let's go down the list and look at these things independently, starting with candles. Candlestick charts show a concise picture of the price action on any time frame, and each candle consists of four main components: the open, high, low, and close. Candles can be red and green, and that is based on the relationship of the open and closing price. Here on this candle, you can see that price opened here. The action progressed steadily all day, and it closed near the highs. On the other side of that, this candle opened high and steadily sold off all day and closed on the lows. So green candles mean the price went up, red candles mean the price went down. The long lines, or sometimes short lines, on either end are called shadows, and that indicates the high and low prices for the day. So you can see here, the action opened, it moved drastically lower, but rebounded to come back up and then closed above where it opened for the day. So that gives you a very quick view of what happened for any particular day. Today was a similar occurrence, only not as wide-ranging. And what we're going to look for is very quickly, which way is the price trending? Is it range-bound and choppy? Or are there more red candles than green candles? Are the candles bigger or smaller? All of this tells us a lot about what's been going on with price lately. We've had a nice uptrend since the low, pivot low in October. It's brought us up to where we are now, and we've got some gaps in here. That's where the price closes at this level and then opens the next day at this level, leaving a big gap. That's good information that we want to be mindful of. And if we kind of scroll out a little bit, we can look at things like has the price been more choppy? Has it been more range bound? Or is it finally in a trend here? Or maybe it's trending downward? All of that very easy to see quickly with a candlestick chart. The next component we'll look at is simply the volume. Volume is always down on the bottom of my charts, and it is just the number of shares traded for that time period in a given security. So this is an SPY daily chart. So we can see down here that this is how many shares traded each day in SPY. The shaded blue area represents a 20-period moving average of the volume. So at a quick glance, we can see, again, was the price up or down relative to the open and close, and was volume higher or lower than average. We can hone in on areas that have a really high volume. This big spike here lets us know that there was a lot of action here, and we had a pivot point here a day after that probably has more significance than if it had happened on very low volume. On this recent action breaking out to new highs, we've got, again, increased volume. So those are all things we want to know about and pay attention to as we look at the chart. Now we're going to move to the top of the chart and look at the Relative Strength Index, or RSI for short. This is a momentum oscillator, which means the calculation can range from 0 to 100. A couple things we want to look for with RSI. First, we might notice, is the calculation above 70 giving an overbought reading, or below 30 to give an oversold reading? Is there a divergence from the price? Take a look at this low again in late October. The stock prices bounced and put in a new low, but at the same time, the RSI was able to hold the previous low. That's a bullish divergence that was an early indicator that this reversal may be significant. In bullish trending times, the RSI very commonly will stay above the 50 mark and in the upper half of the range. As opposed to downtrending times, it'll stay in the lower half of the range. That's an indication that the trend has staying power and can likely persist. Moving on, we're going to look next at the Bollinger Bands. These were developed by John Bollinger, and the bands attempt to establish a bell curve, or a normal distribution for prices. This is based on a midline, which is usually a 20-period moving average. In this case, it's the 20-day moving average. And the upper and lower bands are added based on one standard deviation from the price. Some things we want to look for with the Bollinger Bands are they wide or narrow? Over here they're very wide, here they get very narrow. Are they widening and getting further apart, or are they narrowing and getting closer together? This is an indication of volatility and expanded price ranges, and very often when we see a period of very narrow bands relative to previous history, then those bands start to expand. That can be a good indication of a breakout of the range that may continue. We also want to notice, where is the price relative to the bands? Is it tracking around back and forth in the middle? Is it bumping up against the upper band and pushing it higher? Or is it consistently in the lower end of the bands and driving the trend lower? Now we'll take a look at one of the most popular and simple indicators on any chart, and that's a simple moving average. I use 5 different moving averages on my daily charts: an 8, a 21, a 50, a 100, and a 200-day moving average, and they're all color-coded for easy identification. If I look over to a weekly chart, you'll see this is a 10-week and a 40-week moving average. 10 weeks divided by 5 days in a week, that's roughly the same as the 50-day moving average, and same with the 200-day and the 40-week moving average. And then on a 30-minute chart, which I use often, I will have only a 5-day moving average, and this is important. This is not a 5-period moving average. This calculation is actually correct to give a 5-day moving average. And then this is the week-to-date anchored VWAP, which we'll get to more in a moment. Things you want to look at with the moving average is the price above or below? And is it above the 8, the 21, the 50, the 100, so on and so forth? Those are indications of a trend presence and a strength of trend on a couple of different all those different time frames there. Is price extended far above a moving average? Looking at this peak back here, as price came into the 200-day from the other underside, it was extended far beyond the 21-day to the upper side. Here we got the 21-day is at 409.40, and price was up around 428. It was 20 points above the 21-day moving average. That signals extension and tells us that it may be time for a correction. to show up. We want to notice, are the moving averages far apart or closer together? When the averages are all bunched up together, like right here, and crisscrossing back and forth, you know it's a choppy, trendless market. The 200-day period average is flat. The 8's going up. The 50 is almost flat. The 100 is barely sloping higher. This is all indications of indecision. And then compare that now to this period that we saw over the summertime. The 8 crossed above the 21, which is above the 50, and the 100 and the 200. They're all in right order for an uptrend. They're getting further away as the trend goes on, and that tells us that there is strength and momentum, and that we should recognize that until it starts to change. And when it does, what do we see first? Price dips below the 8-day. Then it dips below the 21-day. Then the 8-day crosses below the 21-day. So these are all indications of the presence of a trend, the strength of a trend, and whether it looks like it's progressing or losing momentum. Now we'll look at the anchored volume weighted average price. The VWAP started as a intraday calculation. It's began with the first trade of every session and ended with the last, and it's the average stock price for that time frame weighted by the number of shares traded at each price. Taking that concept and adding a manual anchor allows us to run the same calculation from different points in time. It's been a very valuable tool for me, and I am constantly surprised and amazed at the relevance when price comes near an anchored VWAP. It very often turns into support or resistance, not always, but quite often, and it's something that has become a big part of my process. And Brian Shannon taught me everything I know about this indicator. He's been a pioneer and an advocate of anchored VWAP for a long time and has done a lot of videos and written a book about it. So I would encourage you to, if you have interest in learning more about this, visit his website and read Maximum Trading Gains with Anchored VWAP. It's really a fantastic book. So briefly, a couple things you want to look at is similar to the moving averages. Is it sloping? Is the price above or below? Have there been reversals at key levels in the past? So has that anchored VWAP been able to provide support or resistance in the past? If it has, then maybe it does so again. We can see that this low, once again pointing to the late October low, came right down to the VWAP, which was anchored to the last October low in 2022. And here it wasn't quite as neat and clean, but right here it hit it almost on the money. So then we add another anchored VWAP from this point, and you can do so on up the line. You can anchor one from the gap here. You can add them anywhere you want. And so again, the trick is to keep it simple. You don't want to put them everywhere, but anchoring to key highs and lows, gaps, Fed days, CPI days, earnings announcements for individual stocks, all of that kind of stuff can be very useful. Finally, we'll get to probably the most basic type of indicator, and that is simple price history. Pivot levels, trend lines, support and resistance. What is it? Well, simply price has memory. It's very common to see particular price levels act as support and resistance. This can result in a pivot or a sharp reversal. We see one here. We see them here. They're all over the chart. Let's add some in. Each of these is a period simply where price reversed and started going back the other way. And so on my charts, I will come in and add a horizontal ray, as the charting software calls it. It's just a dotted line with a price label. And the reason is that makes it very quick and easy to identify where that pivot level took place, what the price is, and that's a good reference point going forward. And so if you think about order flow, pivot levels make very good sense. If a trader or investor has a position set to sell, they may only be willing to do so at a certain price or better. So when that price comes up, they enter their sell orders. And if those orders overwhelm the buy orders, then the price is going to reverse and move lower. The opposite is true as looking for buyers. Once we got down to this level back in October of 22, nobody wanted to sell stock anymore. Buying pressure came in and overtook the selling pressure and produced a pivot level that eventually persisted and took prices higher. So those are things we want to look at and notice. They don't all have significance. Some of them have more significance than others. We could literally draw 1,000 pivot points on this chart. So again, you want to keep it simple and try to stick to the ones that look relevant. Something I do all the time is I update the chart along the way, is go back and erase or delete old pivot levels as they become irrelevant. That keeps the chart clean and easier to read. If we take this a step further and look at horizontal trend lines and support and resistance zones, what we see here is that it's not always just one pivot. So here's a pivot, another one over here, a little bit of support and resistance here, although it wasn't exactly on the specific price. So this becomes handy. Even though the price may not turn around right to the penny, we have a horizontal trend line that may act as support and or resistance. And sometimes it's again, it's not exact, so we have a support or resistance zone. And for these, I draw this rectangle. Think of it basically as a very thick line. The precision isn't there, but the price action is. And we can see here's a reversal, here's a reversal. It tried to go here and came back down before it finally broke up. And then look, once again, back in this zone and poked below it a little bit and then started going back up. So these can be very useful things to look for as well. Then going a step further and adding in some diagonal trend lines. Same concept, only it's on a slope. Once you have two price points that you can connect with a line, you can project that line on out into the future, and then it can be validated or invalidated with a third price point that looks meaningful there. We saw that happen on this trend line here. We saw it happen here. The price stopped, it broke out, and so on and so forth. And again, like the pivot levels, you want to make sure and take these off after they lose their relevance. You could get a very crowded chart, and be mindful that this is potential relevance, potential support and resistance. You never really know that until after the fact, and so it's something to watch with curiosity, but certainly no guarantee that any particular trend line is going to prove to have relevance. And speaking of crowded charts, here is a very crowded chart with all the arrows and labels. So I hope they're useful. I hope this helped you gather an understanding of what all this stuff is. But again, keep it simple. We've got candles, we've got volume, we've got RSI, we've got the moving averages, we've got the Bollinger Bands, some anchored volume weighted average price indicators, and finally pivot levels, trend lines, and some support and resistance zones. If we take all the labels and arrows off, you can get a little cleaner view, but even this has a lot more on it than I would normally tolerate. But for the sake of illustration, we'll leave it on there for now. And that's what you'll find on 90% of the charts that I share. So I hope you have a better understanding and a better idea of my mindset and thought patterns when I draw these charts and when I share them in the articles I write and on X and various places. Again, I like to try to keep it simple, and as much as I like viewing the indicators, it's very important to, and I like even more, removing some indicators. A crowded, complicated chart can be a liability more than anything, and no guarantee that adding more squiggly lines is going to give you a better trade. So be selective. There are those out there that use other popular indicators like the MACD, the Williams percentage, on balance volume, things of that nature. Those are great indicators. I have nothing against any of those. Don't think that I don't like them just because I don't have them on my chart. It's just that I haven't found that they fit well with my trading style, or simply I haven't put in the time yet to learn enough about them and figure out how best to use them. I will occasionally add some Fibonacci levels, retracements or extensions, and some DeMark indicators and a few other things, but those can be complicated, so I do try to use them sparingly. So experiment with your own charts. See what you like, see what you find interesting. There's endless resources out there available to help you learn about these things, and try to keep it simple and learn what the impact is for each of those things. And send me your questions. Put it in the comments here. Reply to the email if you're reading this on my Substack. Hit the contact me button. Hit me up on X. Whatever it is, I'm happy to help. And there'll be plenty more charts coming. So anytime you see one and you're not sure what's going on or what it means, please reach out. I'll do my best to try to explain. And then if I can't do it or you have further interest, there's always the CMT Association. You can go there, cmtassociation.org. Their knowledge base is vast and plentiful. You can learn more than you could ever digest about charts and technical analysis there. So, and again, if you have a question about where to look specifically for something, let me know. I'd be happy to try to point you in the right direction. Thanks for watching the video. One more time, if you're viewing this on YouTube, please do me the favor of hitting the subscribe button and liking the video. You can even share it with a friend if you like. It does make an impact and it's greatly appreciated. If you're on Substack, make sure you're subscribed. This is free content. I'm happy to put it out there. I hope you find it useful and share it with a friend. So thank you for being here. There's more to come. We're going to dig into each of these indicators in more depth and standalone videos for them. So stay tuned for that. And in the meantime, good luck and good trading.